Well, hello everybody. This is Jason Wink. Today is Friday, December 8th. It's about 6:30 p.m., so the market's closed a couple hours ago. And I just wanted to do a video update. I haven't done one of these in probably a couple weeks. And this may be my last update until after Christmas. I have a couple days of travel coming up early next week, and then a rather busy schedule with client meetings the few days after that, leading into Christmas Eve and Christmas Day. So if I don't get a chance to see many of you, have a very Merry Christmas, and I'll be obviously back writing on the blog next week. So actually, I think I just misspoke. I think I said it was Friday. It's Thursday. Excuse me. So the reason I bring that up is because tomorrow, Friday, is I'd say a rather important day. I've been showing on some of these charts this downward trend line that had been forming this year. Now, even though there's been a downward trend line, there's been a series of rallies in the market. So we can see those, like we went through one really up until today. It had been going strong for about 6 or 7 market days or business days. And before that, there was a down trend. And that's sort of been the way things have been the last, especially the last, 5 or 6 months. It seems like every time there's a market dip, there's a rally, but the rallies each time have failed to make up the losses from the prior decline. And we can see that all the way happening back starting in May, again over 6 months ago. There was a decline from May until June. There was a rally. The rally did not make it back to the highs set in May. That was followed by a decline, followed by a short rally, which didn't make it to the high from July. The big drop that happened started at the end of July and went through into early August, where the market sort of traded sideways. Again, series of rallies, then declines and rallies and declines. There was a rather large rally the first week of August, and we can see that here. That brought us to the latest peak in this pattern that we've been trading in. And then since then, we can again see these series of lower highs. So that's hence the line here, this downtrend. Also on this chart, I've drawn in a couple of lines that are parallel to each other, and those are what we call support and resistance lines. Basically, when the market was up above that top support resistance line, each time it had hit it, so back in March, and then it hit it again in June, it would bounce off it and go higher. Once it broke through that, that same line has served as resistance to the upside. So the market's tried a couple of times to get above that range, and it's failed. And so I had made some posts in the last week or two talking about how important it was for the market to really move into a long-term rally. It needed to not only break that resistance line, but it had to move out of this downward trend. And it looked like it was getting ready to do so. It started to stall the last few days, and then today there was a rather large decline, over 2% in the S&P 500. And so I'm not sure, obviously, what will happen. Nobody knows, especially when the markets are so influenced by what's happening in Europe right now. But I'd say that it's still very important. If we don't put in a strong finish to this week, that may lead into a sell-off where the market could drop another few percent. And the next logical place for it to stop, if it goes down and can't break through into a new rally, a new bull market, would be this lower support and resistance line. So the bottom of these two. And this is where, again, each time the market fell, it seemed to want to hit that and bounce off. And once it was below it, that was sort of where it would hit and then go lower. So my expectation, again, would be somewhere around 1,200 or thereabouts on the S&P 500. The technical traders that seem to be influencing the market anyway might start buying a bit. And if that was the case, we would just probably continue this pattern until one way or the other it breaks out. All of this is really important because when we have big moves in the market like we've had lately, it's easy to look at our investments and get frustrated because when the market's going up, if we are in a defensive portfolio, of course, we don't get as much of the market's upside. However, if we decide we want to be more aggressive and the market declines, we get the downside, and we're not happy with that either. And when a market's trading in bizarre ranges like this, and there's a lot of news, sort of uncontrollable external forces that are influencing it, it's very, trying to be an investor. It's difficult to keep a long-term perspective. And so I've been kind of preaching on this for a while that even though this very first decline, this first major decline here, was a bit difficult to forecast, since that's happened, investors should just be cautious. By being cautious, that means having a very diversified, balanced, but conservative portfolio, one that doesn't really have a whole lot to do with the stock market. And you want to have a portfolio like that until the market clearly defines its direction. Right now, there's obviously no clear direction. We have just declines, then rallies, declines, and rallies. And depending on the day you look at your portfolio, a day like today, for example, someone who has a very conservative portfolio would be very happy because they wouldn't have experienced that 2% loss. However, the week or so prior, they'd have been very upset. Not long before that, again, the conservative investor would have felt very smart when there's a big decline. At the end of the day, we have to sometimes forget about what's happened the last 3 or 4 months and just know that in the big picture, sort of the grand scheme of things, it's just plain smart to be conservative in times like this, even though that'll often mean there's 3, 4, 5 day or even month-long rallies that you look like you have a little egg on your face. If the market can't break through, and the key level I've kind of talked about, somewhere between 1270 and 1280, using the S&P 500 as our proxy. If it doesn't move above that, there's no reason to be really optimistic. All we know for sure is that there'll be lots of volatility, and it's to me a lot smarter to try to avoid that volatility. Now, looking at a longer-term view, and this is again why I think it's smart to be conservative, I'll show another chart that I've showed in the past, and I'll give you a little update on it. This is one where I talked about some simple rules that have warned of some of the more major declines in past markets. And I'd explained the rules of this in a previous post, and also highlighted when it gave sort of that same warning, the same triggers that would have caused warnings before the 2008 crash and the 2000 to 2002 crash. Those same warning signs went off in September of this year. And since then, again, we haven't seen the market measurably improve. What's happened is the market had a severe decline. It's since kind of bobbled around, but the overwhelming trend is still down. And until that breaks and changes, investors are wise to be cautious. While this may ultimately end up being a false warning, that happens sometimes, if it turns out to be a correct warning, like it was in 2008 or in 2000, it will really save investors a lot of heartache and loss, and unfortunately, those who don't listen may lose a large portion of their money. So our view has been to stay quite conservative right now, not really have a whole lot in the way of stocks, which can be very frustrating when you have a good month or a good week. But we're about halfway through the trading days of December, because there's quite a few days the market's closed this month. And since that warning went off, while there was a big rally in October, the market did finish down slightly in November, and it's down about 1% now in December. So we'll have to see, obviously, what happens the last 15 or 16 trading days of the month of December. But so far, if we're just looking at winning months versus losing months, hey, this has not been a terrible warning. It's unfortunate that there was a big rally that investors would have missed, but we're looking again at bigger picture, what's going to happen the next 6 months, 12 months, 18 months, and so on. So that's my update for today. Just wanted a quick video update recapping some charts and videos that I have posted in the past. I hope everybody has a wonderful balance to this week and weekend. And again, if I don't post or go on do the video again, have a very Merry Christmas, a Happy New Year, and I will be in touch likely in the next couple of weeks. Thanks again.